When assets remain in your personal name, control may feel simple, but for international families, this can quickly create structural problem. Property, investment portfolios, and company shares across different countries become exposed to probate, succession rules, and cross-border legal processes. Because of this, many families move from personal ownership to structured ownership. One structure that is increasingly used for this purpose in the Middle East is the ADGM Foundation. My name is Shiraz Waheed, and in this video, I will explain to you how ADGM Foundations work, how they are structured, when they are typically used, and how they differ from trust, companies, and other asset holding structures. An ADGM Foundation is a legal entity established within the Abu Dhabi Global Market. ADGM itself is an international financial center with its own legal system based on the English common law. This legal environment is important because many international investors are familiar with the common law-based legal system. A foundation sits somewhere between a company and a trust. Like a company, it has its own legal personality. This means that foundation itself can own assets, enter into contracts, and hold investments in its own name. But unlike a company, a foundation does not have shareholders. Instead, it is established to hold assets for a defined purpose or for the benefits of certain beneficiaries. The founder transfers assets into the foundation, and from that moment, those assets are legally owned by the foundation itself. This separation between personal ownership and structured ownership is one of the main reasons families use these foundations in the long-term planning. Most families use foundations to create a clear governance structure around wealth. When assets remain in personal ownership, decisions depend entirely on the individual owner. Over time, this can create complications, especially when assets are spread across multiple jurisdictions or when several family members are involved. A foundation introduces an organized framework. The founder defines how decisions should be made, who manages the assets, and how the benefits are distributed. These rules are written in the foundation's charter and the regulations that are called bylaws. Because the assets are owned by the foundation rather than an individual, succession becomes easier to manage. The structure continues to exist even if the founder passes away. For families with cross-border assets, this continuity can prevent many of the legal and administrative challenges that arises during probate processes. To understand how an ADGM foundation operates, it helps to look at the main roles involved in the structure. The first role is the founder. This is an individual who establishes the foundation and transfers initial assets into it. The founder also defines the rules that governs how the foundation should operate. The next role is the council. The council is similar to board of directors. Its responsibility is to manage the foundation and ensure that assets are administered according to the foundation's rules. Many foundations also include a role called guardian. The guardian acts as an oversight mechanism. The role is to monitor the council and ensure that the foundation's operations are in line with the founder's intentions. Beneficiaries may also be defined within the structure. These are individuals or entities that may receive distribution or benefits from the foundation. These roles create a governance system where decision-making, oversight, and benefits are clearly separated. Once a foundation is established, assets can be transferred into it. These assets might include shares in companies, investment portfolios, real estate, or intellectual property. From a legal perspective, ownership changes at this stage. The foundation becomes the registered owner of the assets. The founder no longer holds them personally. This shift in ownership is what creates structural benefit of a foundation. Because assets are held within the foundation, they are no longer directly linked to the personal estate of the founder. However, it's important to understand that timing and intent matters. Asset protection structures are designed for long-term planning. If assets are transferred into the structure during an active dispute or legal claims, courts may challenge the purpose of that transfer. Foundations should therefore be established as part of proactive planning rather than reactive measures. People often compare foundations with trust because both are used for asset protection and succession planning. A trust is a legal relationship rather than a separate legal entity. In a trust structure, a trustee holds the assets on behalf of beneficiaries according to the trust deed. A foundation, on the other hand, is its own legal entity. It owns the assets directly and operates through its council. For many international families, foundations are sometimes easier to understand because they resemble corporate governance structures. The role of founder, council members, and guardian creates a framework that is similar to board governance in companies. Both structures can work effectively. The appropriate choice usually depends on the legal jurisdictions involved, the type of assets being held, and the governance preference of the family. An ADGM foundation is really the only family structure used in wealth planning. It usually acts as the top holding layer within a broader structure. For example, a foundation may hold shares in several companies or special purpose vehicle that is called SPV. Those companies may in turn own operating businesses, real estate, or investment portfolios. This layered approach allows ownership to be centralized while operational activities remain separated. When families operate across multiple countries, this type of structure can simplify governance and control. Instead of several individuals owning assets directly, the ownership sits inside a single foundation that oversees the wider structure. It's important to coordinate these structures carefully across jurisdictions. Tax residency, domicile rules, and local reporting requirements can all affect how the structure operates in practice. Another practical consideration is banking. Foundations will require bank accounts to operate, and banks will conduct the same compliance checks they apply to other legal entities. Financial institutions typically review the purpose of the structure, the source of funds, and individuals involved in the governance of the foundation. For well-structured foundations with clear documentation, this process is usually straightforward. However, it is important to approach banking with realistic expectations and proper preparation. Good governance and transparent documentation make banking relationships significantly easier to maintain. So while foundations can be a powerful governance tool, they are not required in every situation. For individuals with smaller number of assets located in a single country, simple structures may be sufficient. Foundations become more relevant when families have multiple assets, cross-border exposure, or long-term succession considerations. The objective is not complexity, the objective is clarity and continuity. Ultimately, the right structure depends on the size of the estate, the jurisdictions involved, and the governance preference of the family. So if you would like our help and would like to explore whether this structure fits your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.